The Federal Reserve is about to make a decision that will reshape the entire precious metals market in 2026. Central banks are quietly replacing their dollar reserves. China has already stopped exporting silver. Physical premiums are beginning to surge, and Wall Street hasn't even woken up yet. Peter Schiff just issued an urgent warning, one that every gold and silver holder needs to hear, because what's coming next could make the difference between wealth preservation and watching from the sidelines. The question is not whether this will happen. The question is, are you positioned before the crowd realizes what's happening? What Peter Schiff revealed next will change everything you thought you knew about precious metals. Welcome to Economy Teller. You know, my friend, in times like these, when the financial system is shifting beneath our feet, the wisest decision you can make is to stay informed. If you appreciate honest, no-nonsense economic analysis, the kind that doesn't sugarcoat reality, then I'd be grateful if you'd subscribe to this channel. Think of it like securing a seat at a table where the truth is still spoken. And please, tell us in the comments, where in the world are you watching this from today? Because this isn't just America's story. This is a global monetary shift. Now, let's examine exactly what's unfolding. Peter Schiff sat across from the camera with the calm intensity of someone who had seen this pattern before, someone who had been right when others were wrong, and someone who was about to deliver a warning that most investors were not prepared to hear. He began by addressing the fundamental forces that were now reshaping the global financial landscape, forces that were no longer theoretical, but visible, measurable, and accelerating. The precious metals bull market heading into 2026 was not being driven by speculation. It was being fueled by three concrete realities: de-dollarization, persistent inflation, and an increasingly accommodative Federal Reserve. Schiff emphasized that these were not distant predictions. These were forces already in motion, already visible in central bank behavior, already reflected in currency markets, and already beginning to reprice the entire commodity complex. He pointed to clear historical data that showed a consistent pattern. During previous Federal Reserve easing cycles, gold had delivered substantial returns, particularly when real interest rates turned negative and confidence in fiat currencies began to weaken. The numbers told a story that was difficult to ignore. Global central banks had been accumulating gold at near record levels, not occasionally, not cautiously, but systematically, month after month, quarter after quarter. Meanwhile, U.S. deficits continued to climb, debt servicing costs were rising faster than revenue growth, and the government was injecting liquidity into the system at a pace that would have seemed reckless just a decade ago. Schiff made a critical observation about market timing. He noted that liquidity injections had a documented track record of triggering sharp weekend gaps in precious metals prices, particularly as Asian markets opened on Sunday night. This was not theory. This was pattern recognition based on years of market observation. Investors who waited for confirmation, who waited for mainstream media to validate the trend, who waited for their financial advisors to give them permission, those investors consistently paid higher prices. Because inflationary policies did not reprice gold and silver gradually. They repriced them rapidly, suddenly, and often over a single weekend. Schiff's message was clear and urgent. The opportunity to position before the crowd was narrowing, not expanding. He explained that the structural drivers behind this bull market were fundamentally different from previous cycles. De-dollarization was not a buzzword. It was a measurable shift in global reserve composition. Countries that had held U.S. treasuries for decades were diversifying, not because they disliked America, but because the mathematics of U.S. fiscal policy had become unsustainable. When a government runs trillion-dollar deficits during economic expansion, when debt servicing costs consume an ever larger share of tax revenue, when the only solution is to print more currency, other nations take notice, and they act. They act by buying gold, by reducing dollar exposure, by building alternative payment systems, by preparing for a world where the dollar is no longer the unquestioned reserve currency. Inflation was the second pillar of Schiff's thesis. Not the transitory inflation that policymakers had promised, but the persistent structural inflation that comes from years of monetary expansion, meeting years of underinvestment in productive capacity. The Federal Reserve had printed trillions. Governments had spent trillions, and that currency was now circulating through the real economy, pushing up prices in energy, in food, in housing, in commodities. And this inflation was not going away, because the policies that created it were not going away. The third force was perhaps the most important, an increasingly accommodative Federal Reserve. Schiff noted that the Trump administration had already made its decision about who would lead the Federal Reserve in mid-2026, and regardless of who that person was, they were going to run the printing press. The signals were already visible. Trump had just ordered Fannie Mae and Freddie Mac to purchase $200 billion worth of mortgage-backed securities, a mini quantitative easing program designed to artificially suppress mortgage rates. This was not free market capitalism. This was government intervention in credit markets, and it was a preview of what was coming on a much larger scale. Schiff's analysis was not sensational. It was systematic. He was not predicting a collapse. He was describing a transition from paper assets to hard assets, from financial engineering to tangible value, from nominal wealth to real purchasing power. And he was making it clear that this transition was already underway. The only question was whether investors would recognize it in time, or whether they would wait until the evidence became so overwhelming that prices had already moved far beyond current levels. The window was open, but it was not open indefinitely. The conversation shifted to something most analysts were overlooking, something that separated theoretical analysis from real-world market mechanics. Schiff leaned forward slightly, his tone shifting from macro strategist to market tactician. He was about to explain why the technical structure of precious metals had fundamentally changed, and why most investors were still operating with an outdated mental map of where support and resistance actually existed. Gold was trading near $4,500, and Schiff made a bold declaration. He did not believe there was significant downside risk, not anymore, not with the forces that were now in play. He stated clearly that gold was not going below 4,300, which meant that anyone buying at current levels faced minimal downside, perhaps $200, while the upside remained substantial and undefined. But it was his analysis of silver that revealed just how dramatically the market had transformed. Silver had done something remarkable, something that only happened once or twice in a generation. It had blown through $50, a level that had acted as a psychological and technical ceiling for over a decade, and it had done so with such force that the entire price structure had reset. Schiff had been forecasting on his podcast that once silver broke above $50, it would become a moonshot, and that 50 would transform from resistance into support. He had been partially right. 50 had acted as support, but only briefly, because the real support was not at 50 anymore. It was at 70. Think about what that meant. An asset that had struggled for years to break through $50 was now holding 70 as its baseline, its floor, its new launching point. The opportunity to buy $50 silver was gone, vanished, erased from the market. Schiff had spent all of the previous year telling people to buy at 30, then at 40, then at 50. Each time, there were skeptics, people who thought it was too high, people who wanted to wait for a pullback, people who believed that patience would be rewarded. Those people were now watching silver trade at $79, realizing that their patience had cost them 30, 40, even 50% in missed gains. Now Schiff was telling people to buy $70 silver, and he knew exactly how that sounded. He knew people would think it was expensive, that they had missed the move, that they should wait for a correction. But he also knew something they did not. After silver had pushed above $83, it had pulled back, and the low of that pullback was just above 70. Since then, silver had never traded below 70, although it had tested that level multiple times. The real support zone, the area where buyers consistently stepped in, was between $71 and $75. That was the ideal entry point, the place where risk-reward was most favorable. But here was the problem, the critical issue that separated theoretical strategy from practical reality. Schiff was not telling people to wait for 71 or 72. He was telling them to buy at 79 right now, immediately, without hesitation. Why? Because he was talking about physical silver, not paper contracts, not futures, not exchange-traded funds, but actual metal, coins and bars delivered to your doorstep. And physical silver was facing a crisis that most investors did not yet understand. Two things were about to happen simultaneously. The spot price of silver was going to continue rising. That was the first component, the obvious component. But the second component was what made this urgent. The premiums on silver products. The difference between the spot price and what you actually paid to acquire physical metal, those premiums were going to soar in 2026. This was not speculation. This was supply chain reality. There was simply not enough physical silver being mined to meet the demand that was building. China, the world's largest silver producer, had already implemented an embargo. They were not exporting any silver, not to anyone, not at any price. They were keeping it all, for their own reserves, for their own industrial needs, for their own strategic positioning. Meanwhile, investors around the world were finally waking up to what was happening with silver. The industrial demand was relentless. Solar panels, electronics, electric vehicles, medical applications. The investment demand was accelerating. Individuals, institutions, sovereign wealth funds, and the supply was fixed, constrained, unable to expand quickly enough to meet this convergence of demand. Schiff painted a scenario that was both logical and alarming. Imagine waiting for silver to pull back to $71, being patient, being disciplined, following the textbook approach. By the time that pullback arrived, if it even arrived, the premium on physical products might have widened by $8, $10, even $15 per ounce, which meant that the total cost of acquisition could actually be higher than simply buying at $79 today. The spread between paper price and physical price was about to decouple in a way that most investors had never witnessed. Schiff's warning became more direct. If you were a physical silver buyer, someone who wanted metal in hand, someone who understood the difference between owning a promise and owning an asset, you had to buy now, not because the price was low, but because the product was available. He admitted something that sent a chill through anyone paying attention. He believed that later in the year, his company would be out of stock, completely, unable to deliver physical silver even to customers willing to pay. Or if they could source it, delivery times would stretch from weeks to months. Right now, the supply existed. The premiums had not yet spiked, and delivery was prompt. That window would not remain open. What Schiff revealed next was something that caught even experienced investors off guard. Because this was not just about gold and silver anymore. The entire commodity complex was moving, shifting, repricing itself in ways that had not been seen in over 2 decades. And the implications were staggering. Schiff paused, letting the weight of what he was about to say settle in. Then he dropped a data point that changed the entire conversation. Copper had crossed $6 per pound for the first time in history. Not revisited, not retested, but crossed for the very first time. This was not a monetary metal. This was an industrial metal, the backbone of construction, of electrical infrastructure, of the entire green energy transition. And it was breaking out to all-time highs. But copper was just the beginning. Nickel was moving, zinc was climbing, lead was advancing. Every base metal, every industrial commodity was participating in a synchronized rise that spoke to something deeper than simple market momentum. This was a structural shift, a repricing event driven by forces that had been building beneath the surface for decades. Schiff explained what most analysts were missing. The world had stopped investing in commodity production. For 30 years, maybe longer. Mining companies had been starved of capital. Exploration budgets had been slashed. Development projects had been canceled. Capacity expansion had been treated as financially irresponsible. Wall Street had rewarded mining companies that returned cash to shareholders, not companies that invested in future production. Environmental regulations had made new projects nearly impossible to permit, even when viable deposits were discovered. And now, the consequences of those decades were arriving all at once. Demand was rising, driven by electrification, by infrastructure spending, by population growth, by the physical requirements of a modern economy. But supply could not respond. You cannot simply turn on a mine. Exploration takes years. Permitting takes years. Construction takes years. Even once a deposit is found, it might be a decade before production begins. Schiff called it a perfect storm. If you were long precious metals, if you owned physical gold and silver, if you had positioned in mining stocks, this was the environment you had been waiting for. But if you were an industry that needed these metals, if you were a manufacturer, a builder, a technology company dependent on reliable commodity inputs, this was a disaster unfolding in slow motion. Agricultural commodities were next on Schiff's list. He believed they were going to boom, not just rise, but genuinely boom. Because the same underinvestment that plagued metals had also plagued agriculture, fertilizer production, farming equipment, crop science, and food demand did not negotiate. It did not wait. It could not be postponed. Even oil, which had held at lower levels longer than Schiff expected, was showing signs of bottoming. He mentioned Venezuela, the geopolitical instability, the supply disruptions that were beginning to ripple through energy markets. Oil was looking strong, consolidating, building energy for the next move higher. This was an inflation-fueled commodity bull market, but it was also something more dangerous. It was a supply shortage born from decades of neglect, of short-term thinking, of prioritizing quarterly earnings over long-term capacity. And those two forces together, inflation plus scarcity, created a multiplier effect that most investors were not prepared for. Then Schiff shifted to the opportunity that almost nobody was discussing: gold and silver mining stocks. The previous year had been exceptional for senior mining companies, the large-cap producers with established operations and steady cash flow. They had finally begun to catch up to the metal prices, delivering returns that reminded investors why the sector existed in the first place. But Schiff was not focused on the seniors anymore. He was focused on the juniors, the true juniors, the small exploration companies with market caps under 500 million, under 200 million, sometimes under 50 million. These companies had barely moved, while gold had doubled, while silver had tripled. Many junior mining stocks were trading at the same levels they had been at years earlier. Some were trading lower. The valuation gap was absurd, irrational, unsustainable, and Schiff saw a pattern repeating. In 2025, silver had caught up to gold, then surpassed it, delivering percentage gains that left gold investors wishing they had allocated differently. In 2026, he believed the juniors would do the same thing to the seniors. They would catch up, then surpass, delivering multiples that would remind people why junior mining stocks existed as an asset class. This was not a sector for the faint of heart. Junior miners were volatile, speculative, dependent on exploration success and capital markets access. But in the right environment, with the right tailwinds, they were explosive. Schiff managed a fund specifically designed to capture this opportunity, the Europe Pacific Gold Fund, ticker symbol EPGIX. It was not invested in the big companies found in the GDXJ, the mid-tier producers that had already run. It was concentrated in the real juniors, the little guys, the companies that had not participated yet, the ones with the largest valuation gaps and the most asymmetric upside. His firm also ran separately managed accounts for clients who wanted customized exposure to the mining sector. With significant weightings toward these junior exploration names, Schiff was positioning aggressively, not recklessly, but with conviction born from understanding market cycles and recognizing inflection points. He had seen this before, not exactly, but close enough to recognize the pattern. He knew that juniors move last, but moved most. He knew that by the time mainstream investors discovered them, the easy money would already be made. And he knew that right now, at this moment, the opportunity was still available. The metals were moving. The fundamentals were aligning. The supply constraints were real. But the junior mining stocks were still priced as if none of it mattered. The disconnect would not last. And when it closed, when capital finally flowed into the forgotten corners of the mining sector, the moves would be violent, sudden, and life-changing for those positioned correctly. Schiff's tone shifted one final time, from tactical opportunity to systemic warning. Because what was driving this entire precious metals bull market was not just supply and demand. It was not just commodity cycles or mining equity valuations. It was something far more dangerous. It was policy, monetary policy, fiscal policy, the kind of policy that destroyed currencies and collapsed empires throughout history. And it was accelerating. Schiff turned his attention to the Federal Reserve and the Trump administration, two entities that were about to embark on a monetary experiment that would make previous easing cycles look restrained by comparison. Trump had already made his decision. He had chosen who would be installed to run the printing press in mid-2026. Schiff did not mince words. He called them flunkies, loyal operators who would follow orders rather than exercise independent judgment. And the orders were clear. Print, print continuously, print aggressively, print without restraint. The evidence was already visible. Trump had just ordered Fannie Mae and Freddie Mac, the government-sponsored enterprises that backstopped the mortgage market, to purchase $200 billion worth of mortgage-backed securities. Why? To artificially suppress mortgage rates, to stimulate housing demand, to create the illusion of affordability even as prices climbed. This was Trump's own version of quantitative easing, running through the GSEs instead of the Federal Reserve, but the effect was identical. More money creation, more currency debasement, more inflation disguised as economic stimulus. Schiff made a prediction that was both bold and terrifying. He believed central banks would buy more gold in 2026 than they had bought in 2025. Not just the central banks that had already been buying, China, Russia, Turkey, India, the usual suspects, but other central banks, the ones that had stood on the sidelines, the ones that had watched while others accumulated, the ones that had maintained faith in the dollar system. They were going to panic. They were going to FOMO into gold, fear of missing out driving reserve managers to abandon decades of dollar loyalty, because something historic had already happened, something that most people had missed. Gold had replaced U.S. Treasuries as the largest reserve asset held by central banks globally. Read that again. Central banks now held more gold than U.S. government bonds. This was not a temporary shift. This was a structural realignment that would continue for many years, perhaps decades. The trend was massive, important, and irreversible. But it was not just central banks anymore. Schiff noted that individual investors, retail buyers, Wall Street institutions had been largely absent from the precious metals market in 2025. They had missed the entire move, watching it from the sidelines, while gold doubled and silver tripled. That was about to change. 2026 would be the year Wall Street woke up, the year mainstream finance discovered precious metals, the year allocations shifted from paper assets to hard assets. And when that capital flow began, when trillions of dollars in institutional money started chasing limited physical supply, the price moves would dwarf what had already occurred. Schiff's analysis took a darker turn. He drew a parallel that anyone who understood financial history would recognize immediately. We were not in 2008. We were in 2007. We were on the edge of a crisis, not in the middle of one. The Trump foreign policy, the tariffs, the deficit spending, the economic policies being implemented, these were creating the conditions for what Schiff had been forecasting for years. The real crash. He had written about it in his 2013 book, The Real Crash, America's Coming Bankruptcy. He had expected it to happen much sooner, right after the quantitative easing programs that followed the 2008 financial crisis. But it had not happened then. The dollar crisis had been postponed, delayed, pushed further into the future by more intervention, more manipulation, more can-kicking, and that delay had only made the eventual reckoning worse, much worse. This was not going to be a financial crisis. This was going to be a dollar crisis, a sovereign debt crisis, a complete loss of confidence in the world's reserve currency. The bond market was going to collapse. Not correct, not decline, but collapse. And when that happened, everything priced in dollars would reprice violently. Schiff referenced something eerily familiar. He had been watching Larry Kudlow's show, where Kudlow was describing the Trump economy as the greatest story never told. Those exact words. The same words Kudlow had used in 2007 to describe the George W. Bush economy. Just months before the financial crisis destroyed that narrative completely. Schiff had been one of the few voices warning about the housing bubble back then, warning about the unsustainable debt, warning about the illusion of prosperity built on leverage and speculation. He had been ridiculed, dismissed, called a perma-bear, until he was proven right. And now, the same people who had been wrong then were making the same mistakes again. Republicans celebrating because a Republican was in the White House, ignoring the fundamentals, ignoring the mathematics, ignoring the warning signs. But the economy was actually in worse shape now than it had been under Bush. The mistakes being made were bigger, the imbalances were larger, the debt was more extreme, and the policy responses being prepared were even more reckless. Schiff systematically dismantled the narrative of a strong economy. If the economy was truly booming, if it was the strongest in history as Trump claimed, then why was the dollar so weak? Why was gold at all-time highs? Why were deficits exploding during what was supposed to be an expansion? In a genuinely strong economy, tax revenues surge, deficits shrink, confidence rises, but consumer confidence was at record lows. Trump's approval rating on the economy was near historic lows. People felt poor because they were poor. The disconnect was not between voter perception and economic reality. The disconnect was between government statistics and actual conditions. Trump understood this once. As a candidate in 2016, he had called government numbers BS. He had campaigned on the idea that official data was manipulated, meaningless. He had been right then. But now, as president, he hid behind those same numbers, using them to justify claims that contradicted what ordinary Americans experienced every day. And the ultimate proof of the illusion was the stock market. Yes, the S&P 500 hit new record highs. The Dow Jones approached 50,000. The Russell 2000 broke out. Politicians pointed to these numbers as evidence of success. But Schiff asked the question that revealed everything. Measured in what? Measured in dollars? Yes, stocks had gone up. But measured in gold? Measured in silver? U.S. equities had been falling for years. 25 years ago, the Dow was at 10,000. Gold was under $300. Now the Dow was at 50,000. But gold was over 4,000. The Dow had gone up 5 times in nominal terms, but gold had gone up more than 13 times. Which meant that in real terms, in purchasing power terms, in actual wealth terms, the stock market had lost tremendous value. This was the politician's favorite trick. Destroy the currency, then celebrate the nominal price increases that result, claim prosperity while delivering poverty. And that trend was not reversing, it was accelerating. U.S. stocks would continue falling when measured in gold and silver, not because stocks were inherently worthless, but because the currency they were priced in was being systematically debased. Schiff's final message was unambiguous. The precious metal cycle was shifting into its most aggressive phase. Capital was moving beyond the obvious names, beyond the senior producers, into the areas that had been left behind. True junior mining stocks remained historically cheap despite the decisive moves in gold and silver. In prior cycles, juniors had lagged early, only to outperform explosively once monetary stress became unavoidable. And monetary stress was no longer theoretical. De-dollarization was accelerating. Deficits were expanding. Policymakers were leaning toward renewed easing. Central banks had already made their choice. Gold over treasuries. Individual investors were beginning to follow. And throughout all of this, U.S. equities measured in real money, in gold and silver, continued losing value. The illusion of nominal gains was masking the reality of wealth destruction. The opportunity was still available, but it was not permanent. Supply constraints were tightening. Premiums were beginning to rise. Inventory was depleting. The window was open, but windows close. And when this one closed, when the crowd finally understood what was happening, when Wall Street allocation committees finally approved precious metals exposure, when sovereign wealth funds finally diversified into hard assets at scale, the prices would be far higher, the availability far lower, and the opportunity far smaller. Schiff had delivered his warning, not with panic, not with hype, but with the calm certainty of someone who had studied monetary history, who had watched these patterns unfold before, who understood that what was coming was not unprecedented, just inevitable. The question was not whether this would happen. The question was whether investors would position themselves accordingly, or whether they would wait, doubt, hesitate, and watch the opportunity pass them by, as it always did for those who waited for certainty in uncertain times.